This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Fundcast. Today, we're doing a deep dive into something really specific, but actually incredibly powerful happening right here in Luxembourg. We're going to unpack how the Grand Duchy has, engineered this really sophisticated ecosystem, the goal, to become a top hub for financing innovation-driven companies. And the secret sauce, based on the material we've looked at, seems to be this deliberate mix. It's a combination of very favorable tax benefits for intellectual property, IP, and some, frankly, remarkably strong lender-friendly security laws.
Exactly. It's this synergy that really makes the difference.
And that's what we want to explore with you today.
Right. If you're in alternative fund financing or maybe involved in sectors like tech, life sciences, digital assets, competitive advantage is absolutely key. And in these areas, the real value, it's often not in the buildings or machines. It's intangible. It's the IP, the patents, the software code, the know-how.
Stuff that's historically been tricky to finance against, right?
Yeah, exactly. It could be quite difficult. But what's fascinating and what the sources really highlight is how Luxembourg has specifically created a landscape. Well, it lets fund managers and companies turn this often abstract IP into something concrete, a high-value asset class you can actually finance.
A financeable asset. That's the key transformation.
Yes, it's a major strategic shift, enabling that move.
And the sources we're drawing on, they point to two main pillars. They call them formidable legal pillars that make this possible.
That's the core of it. We'll need to look at each one. First, there's a specific tax regime for IP income. And second, a very powerful financial collateral law.
Okay, so we'll break down each pillar. Pillar 1, the tax side. Pillar 2, the security law. And then
we'll connect them, see how they work together in practice.
Yeah.
Especially looking at structures like convertible loans secured by that IP.
Got it. So get ready. We're going to uncover how IP moves from just being an asset on paper to a real engine for financing growth here in Luxembourg.
Yeah, there are some surprising mechanics in how these legal and tax frameworks mesh together.
Let's dive in. Okay, let's start by setting the strategic context. The source material talks about a strategic imperative in alternative fund financing. What's driving this, and why is IP so central?
Well, the imperative, it really stems from intense competition and also just the changing nature of where value lies today. Traditional finance often looks for tangible things, buildings, equipment.
Right, bricks and mortar.
Exactly. But if you look at innovation sectors, biotech companies with their drug pipelines, software firms with their algorithms, digital platforms, the core value, the thing that gives them an edge, it's their intellectual property. So fund managers investing there, they need better tools. They need ways to fund growth without giving away too much equity early on. And they need the assets their companies hold, this IP, to be, attractive collateral for lenders.
So it's about making the intangible tangible enough to finance.
Precisely. And what Luxembourg has done, according to the sources, is create this environment where IP isn't seen as, risky or illiquid. It's transformed into a high-value, genuinely financeable asset class.
And that gives funds operating here an edge.
A significant one, yes, in attracting capital and deploying it effectively into those innovation-focused businesses.
And this transformation relies on those two formidable legal pillars you mentioned earlier. Can you name them again for us?
Sure. The analysis points squarely to two things. First, Article 52 of the Luxembourg Income Tax Law. That's the IP box tax regime. And second, the Law of 5 August 2005 on financial collateral arrangements, often just called the Collateral Law.
Okay, Article 52 LIR and the 2005 Collateral Law. Before we dissect them, give us the quick preview. What makes each one so powerful for financing IP? Let's start with the IP box.
Okay, the IP box. Its main job is to make the income from certain types of IP incredibly tax efficient. The headline benefit, as the source details, is an 80% exemption.
80%?
Yes, 80% off both corporate income tax and municipal business tax. But crucially, it applies to the net eligible income from qualifying IP.
Net eligible income. Okay.
And this is where it gets interesting. Because only 20% of that income gets taxed at standard rates, the result is a remarkably low effective tax rate. For a company in Luxembourg City, the analysis in the source suggests it's around 4.774% for tax year 2025.
Wow, under 5% effective rate on that IP income.
Exactly. Think about that. It means almost 95 cents of every euro of eligible IP income is potentially available after tax. You can use it to pay down debt, reinvest, whatever. It makes the cash flow from that IP incredibly efficient for servicing loans.
Which is key for these financing deals.
Absolutely. And it's important to remember, this isn't just a giveaway. The modern regime, updated to align with OECD standards, specifically the BEPS project, it links these benefits directly to real R&D substance, actual research and development happening here. It rewards active innovation.
So the IP box boosts the after-tax value, the cash flow potential of the IP. How does the second pillar, the collateral law, fit in?
But collateral law is what makes that valuable, tax-efficient IP useful as security. It lets you pledge it effectively. It's widely seen as one of the most creditor-friendly security laws in Europe. It creates a real safe harbor for secured lending.
A safe harbor.
Yeah.
What are the key features?
Two main things stand out. First, bankruptcy remoteness. This is huge for lenders. If the company giving the pledge gets into financial trouble, insolvency, restructuring, a valid pledge under this law holds up. It remains effective, enforceable.
So the lender's claim on the IP is protected even if the borrower goes under.
Yes. It's shielded from being challenged or clawed back into the general pool of assets for other creditors. It gives lenders massive certainty their collateral is safe.
Okay, bankruptcy remoteness. What's the second key feature?
Speed and flexibility of enforcement. If something goes wrong, what the contract calls an enforcement event, the lender can act fast. They can enforce their security rights often without needing a court order, without long delays or prior notice period.
Out-of-court enforcement?
Yes. Things like selling the IP privately or even appropriation, where the lender can essentially just take ownership of the IP to cover the debt. And the source highlights some very recent developments, late 2024.
Ah, yes, the confirmations.
Exactly. Yeah. Legislative changes and a Supreme Court ruling confirm that this law's protection has global reach. It applies against insolvency proceedings anywhere in the world, inside or outside the EUEA. That's a massive comfort for international lenders.
Okay, so Pillar 1, tax efficiency boosts IK value. Pillar 2, robust security law makes that value bankable and safe for lenders globally. How do they combine in practice? What's the structure?
Well, the sources point to the IK-backed convertible loan as a classic example of this synergy in action. You have a specialist lender providing a loan maybe to the fund itself, or an SPV holding the IP.
An STV, a special purpose vehicle?
Yes, a dedicated company. And that loan is secured by a pledge over the valuable IP assets using the collateral law.
And benefits for each side, for the fund or company borrowing.
For them, it's primarily about getting growth capital that's less dilutive than selling more shares. Preserves ownership. It gives them cash runway to hit milestones, maybe get a better valuation later. And crucially, they service the debt interest using that IP income that's taxed super efficiently thanks to the IP box. It lowers the real cost of capital.
Makes sense. And for the lender?
For the lender, it's a strong risk-return setup. Their downside is protected by this first-ranking security over the core IP asset, backed by the very robust collateral law. Their upside comes from the convertible part, the option to convert the debt into equity, or maybe warrants, letting them share in the company's success if it takes off.
Belt and braces, as you said earlier.
Exactly. Security plus potential equity upside. It's a structure really enabled by combining these two specific Luxembourg frameworks.
It really sounds like a finely tuned machine, leveraging both tax and law. Okay, great overview. Let's now properly dive into Pillar 1, the IP box regime. Article 50, Turel IR. Tell us more.
All right, let's unpack the IP box. The current version, which kicked in on January 1st, 2018, was a major overhaul, not just a tweak. It was redesigned specifically to align with international tax standards.
You mentioned the OECD's BEPS project, base erosion and profit shifting.
Precisely. BEPS Action 5 targets harmful tax practices. The old Luxembourg IP regime, while popular, drew criticism because it didn't demand a strong enough link between the R&D creating the IP and Luxembourg itself, where the tax benefit was claimed.
So the change was about adding substance.
Exactly. The modern regime ties the tax benefits directly to substantive economic activity, specifically the research and development work done by the taxpayer or linked to Luxembourg. It shifted from a potentially passive benefit to an active incentive for R&D substance here.
Okay, so what is the core proposition now, that 80% exemption you mentioned?
Yes, that 80% exemption is the heart of it. It applies to both corporate income tax and municipal business tax, but only on the net eligible income from qualifying IP assets. Plus, the source notes, qualifying IP is also 100% exempt from Luxembourg's net wealth tax.
And the impact is that low effective tax rate.
Right, because only 20% of the eligible income faces the standard tax rate, which in Luxembourg City for 2025 is around 24.94%. The math works out to that very attractive effective rate of about 4.774% on that specific IP income stream.
And that huge tax saving makes the IP cash flow much more valuable for things like servicing debt.
Absolutely. It directly boosts the financeability of the asset. But again, it's not automatic. It's conditional.
Conditional loan.
On that R&D substance link, this is the core of the modern regime, implementing the OECD's modified nexus approach. It uses a specific formula to calculate how much of your net IP income actually qualifies for the 80% break.
A formula. Okay.
And the principle is simple. The tax relief you get should match the proportion of qualifying R&D costs you incurred yourself, or paid unrelated third parties to incur for you.
Okay, so let's get specific. What kind of IP qualifies? What assets are eligible? And importantly, what's excluded now compared to the old regime?
Right, the scope is definitely narrower, more focused on real R&D results. Based on Article 52 and guidance from the tax authority, the ACD, Administration de Contribution directs the asset generally needs to have been created, developed, or improved after December 31st, 2007. The main eligible categories are, first, patents and functionally equivalent rights. This is quite broad. It includes national and international patents, utility models, SPCs, supplementary protection certificates for pharma and plant products.
SPCs, right?
Also, SPC extensions for pediatric medicines, plant variety certificates, and orphan drug designations. Basically, legally protected inventions.
Okay, patents and equivalents. What else?
The second big one is copyrighted software. Software protected by copyright law is explicitly in.
And what's explicitly out now? This was a big change, wasn't it?
It was. Driven by international standards, the modern regime specifically excludes marketing-related intangibles. So things like trademarks, brand names, trade names, service marks, domain names. They do not qualify for the IP box benefits.
Ah, so it's really focused on the tech and science R&D, not brand value.
Exactly. That shift reinforces the link to substantive R&D activity.
Okay, so we know the assets that qualify. What about the income from those assets? What types of income get the 80% exemption?
Good question. Article 50 Terror, paragraph 1, number 7 lists them out. The most obvious is royalties payments you receive for letting someone else use your qualifying patent or software. Standard licensing income.
Makes sense. What else?
It also covers embedded IP income. This is a bit more complex. It's the portion of the sales price of a product or service that's directly attributable to the qualifying IP inside it. Sure. Say you sell a machine that uses your patented technology. Part of the machine's price is really income from that patent. The law says you have to use the arm's length principle here. Think Article 56, BIS-LIR, and OECD guidelines.
Meaning you need a transfer pricing study.
Essentially, yes.
Yeah.
You need to objectively determine and document how much that product's income is genuinely from the IP versus manufacturing, sales, or other functions. It requires proper analysis.
Okay. Royalties, embedded income, anything else?
2 more. Capital gains from selling or transferring the qualifying IP asset itself are eligible. And also, legal indemnities compensation you might receive from winning a lawsuit over infringement of your qualifying IP.
That embedded income piece sounds like it requires careful accounting.
It definitely does. It goes back to substance. The authorities want to see that the income claimed truly derives from the IP, valued properly.
Right. Now let's get to the heart of it, that nexus approach calculation. You said it's the core mechanism linking tax benefits to R&D spend. How does this formula actually work?
This is where the substantial activity rule really bites. The formula decides what percentage of your net eligible IP income qualifies for the 80% break, and is deliberately structured to favor R&D you do yourself, or that you pay independent parties to do. The formula basically is exemptable income equals eligible expenses divided by total expenses times net eligible income.
Okay, let's break that fraction down. Eligible expenses over total expenses. What's net eligible income first?
Net eligible income is your starting pool of potentially exempt income. It's the gross eligible income, those royalties, embedded income, etc., minus all the direct and indirect costs related to earning that income or maintaining the IP in that year. And importantly, the source notes. If you have a net lock on an IP asset 1 year, you have to carry that forward and offset it against future profits from that asset before you can claim any exemption.
Okay, so that's the pool. Now the fraction. Eligible expenses, the top number, the numerator. What counts?
Right. Eligible expenses are essentially your qualifying R&D costs.
Yeah.
Costs you incurred for R&D activities directly linked to creating or improving the specific IP asset. This includes R&D done by your own team internally, or R&D you outsource to unrelated third parties. It can also include R&D done by your permanent establishment, your PE, in another EEA country, as long as that PE isn't already getting a similar IP tax break there.
And what's specifically excluded from eligible expenses?
This is key. The law explicitly excludes several things from this numerator. The cost of acquiring the IP in the first place, R&D costs you outsource to related parties within your group, as defined in Article 56 LAR, also interest, financing costs, and real estate costs.
Why exclude this?
Because they don't represent the taxpayer's own direct R&D effort or R&D commissioned at arm's length from an independent party. They want to reward your substance.
Okay, so the numerator is your own R&D spend or independent outsourced R&D, but you mentioned a 30% uplift. What's that?
Yes, the 30% uplift. This is a bit of a concession. It lets you increase the value of your eligible expenses, the numerator, by up to 30%. But the total can't exceed the denominator, total expenses.
And the purpose of this uplift?
It's basically to partially compensate for those costs that are excluded from the numerator, like acquisition costs or related party R&D costs. It makes the regime a bit more attractive, even if you have a mixed strategy. Maybe you acquired some tech or used some group R&D services alongside your own efforts.
Okay, numerator is eligible R&D, potentially boosted. What's the denominator, total expenses?
Total expenses is the broader cost base for the IP.
Yeah.
It's the sum of those eligible expenses, the numerator amount before any uplift, plus any IP acquisition costs, plus any related party R&D costs.
Right, so acquisition costs and related party R&D are in the denominator, but not mostly in the numerator. How does that structure influence company decisions?
This is the strategic implication. Look at the ratio. Eligible expenses, total expenses. If a company heavily relies on buying IP or uses its own related R&D center in another country, those acquisition costs and related party costs inflate the denominator, but they don't fully count in the numerator.
So the fraction gets smaller.
Exactly. Mathematically, it reduces the nexus ratio. A smaller ratio means a smaller percentage of your net eligible income qualifies for the 80% exemption. This creates a really powerful financial nudge, a signal for companies to actually do their R&D in Luxembourg or to use independent third parties rather than just buying IP or using captive related party R&D hubs elsewhere.
So it directly impacts M&A versus organic growth decisions and where you locate R&D.
Absolutely. If you want the maximum tax benefit from your IP, the regime strongly incentivizes you to anchor the underlying R&D substance here. It rewards local innovation activity.
So definitely not passive, it's actively shaping behavior.
That's the design, fostering innovation within the Grand Duchy.
Okay, with such big tax benefits tied to these complex calculations, I bet the documentation requirements are pretty intense. The source mentions documentation and compliance.
Oh, absolutely. Big benefits mean strict rules. Article 52, paragraph 9 lays it out. The tax authority, the ACD, needs detailed proof. The default method is asset-by-asset tracking. That means you need to track all the relevant expenses, eligible and total, and the income, specifically for each qualifying IP asset. Every patent, every software program. Very granular.
That sounds incredibly detailed.
It can be. So there's an alternative, the product-based approach. If you have a product or service that relies on multiple IP assets and tracking per asset just isn't feasible or logical given how your R&D is set up, you can track costs and income based on the product or service level. But you need solid justification for doing this, and you have to be consistent.
And transfer pricing is still key.
Yes, especially for that embedded income. All your internal transactions related to the IP licensing between group companies, cost sharing must follow the arm's length principle. That's Article 56 LIR and OECD guidelines. You need the TP documentation to back it up.
And keeping all the records.
Paramount. Documentation availability. You have to keep everything: project plans, cost allocation methods, TP studies, contracts, invoices, proof of the IP itself, usually for 10 years. The source mentions Model 760 is the specific annual form for reporting the IP box calculation to the ACD.
And the warning, if you don't comply.
The source is blunt. Failure can mean denial of the benefits, possibly even retroactively. This isn't something you just pick a box for. It needs serious, integrated effort from tax, legal, finance, and the R&D teams right from the start. It's a reward for discipline.
Okay, so that's pillar one, the IP box. Boosting IP's after-tax value via tax efficiency, but tied strictly to R&D substance and requiring robust documentation. Powerful. Now, pillar two, The law that lets you use that valuable IP as security. The Financial Collateral Law of 5 August 2005.
Right. This law is really fundamental to Luxembourg's standing as a financial hub, especially for secured deals. It implemented the EU's Financial Collateral Directive, but Luxembourg did it in a particularly creditor-friendly manner, creating what's often called that safe harbor for collateral.
Creditor-friendly haven. What are the key features creating this safe harbor?
The absolute standout feature is bankruptcy remoteness. For a lender, this is gold. A valid pledge under this law is legally protected if the borrower has financial distress, insolvency, reorganization, whatever.
It survives bankruptcy.
Yes, the pledge remains valid, enforceable. The secured creditor keeps their priority claim on that specific IP asset. It's shielded from clawback rules or freezes that might normally apply in bankruptcy. It essentially ring-fences the collateral for the lender. Huge certainty.
Okay, bankruptcy remoteness. What else makes it so strong?
Second is the speed and flexibility of enforcement. When a pre-agreed enforcement event occurs, and we'll see that can be defined very broadly, the lender can act immediately, often without needing a court order or giving formal prior notice.
No court involved. That's fast.
Very different from many other places where enforcement can be slow and court-supervised. Here, the law allows for quick, out-of-court action.
Like what kind of action?
Well, the source mentions private sale of the pledged assets, provided it's done on commercially reasonable terms, but also, significantly, appropriation. The lender can simply take ownership of the pledged IP in satisfaction of the debt. Very powerful. And there's also broad contractual freedom. The parties can agree on a lot of the terms, especially the definition of that enforcement event. Recent updates confirm this can be incredibly broad. An event of default or any other event whatsoever is agreed between the parties.
Any event whatsoever.
Yes. So it's not just missing a payment. Lenders can negotiate triggers based on financial health indicators, covenant breaches, anything signaling increased risk, allowing very early intervention.
That sounds incredibly lender protective. And the source mentioned reinforcing the fortress, recent updates, particularly that 2024 development on global reach.
Yes, that was a major clarification and really important for the international market. Early in 2024, a Court of Appeal ruling caused some ripples. It suggested the law's insolvency protection might only work against bankruptcies opened within the European Economic Area.
Which would worry lenders outside the EEA.
Exactly. Lenders in, say, New York or London, lending to Luxembourg structures. But the reaction was swift. By July 2024, the Luxembourg legislature amended the law, explicitly stating it applies against national or foreign provisions, defining foreign to cover any state, inside or outside the EEA. They said this was just clarifying the original intent.
And the Supreme Court weighed in, too.
It did. In December 2024, the Supreme Court, the Cour de Cassation, overturned that earlier appeal court ruling. It definitively confirmed the global scope. The law protects against insolvency proceedings opened in any third country, period.
Why was the sequence so important?
Because it was a massive signal. It showed Luxembourg's legal and political system is deeply committed to defending the legal certainty that underpins its financial sector. For any global lender, it provides huge reassurance that their Luxembourg security, including over IP under this law, will stand up, even if the borrower's bankruptcy happens back home or elsewhere. It dramatically cuts cross-border legal risk.
A strong defense of their key legal infrastructure.
Absolutely. And the source also notes other modernizations updated auction rules, confirming it applies to DLT-based financial instruments, keeping the law current.
Okay, so the collateral law provides this incredibly robust framework for creating and enforcing security, offering exceptional protection and flexibility, especially for creditors. How do you specifically apply it to pledge IP? What's involved in the IP pledge agreement?
Right. While often used for financial assets like shares or bank accounts, the law works perfectly well for intangibles like IP. You can pledge specific IP rights patents, copyrighted software as security. It starts with a written agreement. The pledge needs to be documented in writing. Usually a private agreement, sui sine privé, is enough under the collateral law, though sometimes parties might opt for a notarial deed for extra formality, especially cross-border. The underlying legal idea is dispossession, transferring control. For intangibles, this happens through perfection formalities. Perfection is the critical step. It makes the pledge effective not just between the borrower and lender, but against everyone else, third parties. This is vital for priority and enforceability.
How do you perfect a pledge over IP?
It depends on the type of IP. For registered IP, things like trademarks, designs, patents that have official public registers, perfection requires recording the pledge in that specific register. So, for Benelux trademarks designs, you register it with the BOIP, the Benelux Office for Intellectual Property. For national patents, with the Patent Registry at the Ministry of the Economy. This registration puts the world on notice that the asset is pledged.
Like a public flag on the asset. What about unregistered IP, like software?
For unregistered IP, like copyrighted software, there's no central registry. So the pledge is typically perfected just by signing the written pledge agreement itself. But to make it practically effective against third parties, the agreement needs to be really well drafted. It needs a crystal clear description of the pledge software and strong contractual clauses giving the lender control-like rights to approve licenses or transfers.
So for unregistered IP, the strength is all on the contract drafting and control clauses.
Exactly. Unlike registered IP, where the public notice provides that external shield, here the contract is the shield, largely, a key difference.
Very important distinction. Okay, let's zoom in on the pledge agreement document itself. The source gives a clause-by-clause look. What are the essential parts we should understand?
Right. The pledge agreement is the rule book for the security. They're always tailored, but follow a common structure. You start with the granting clause. This is the formal bit where the pledger grants the security. It'll typically say something like, they grant a first-ranking pledge over the defined pledged assets, the specific IP, as continuing security for the secured liabilities, the debt. First ranking means priority. Continuing security means it covers the debt until fully paid off.
Okay. And secured obligations.
This defines precisely what debt the IP secures. For a convertible loan, it has to be broad. Principal, interest, including any PIK interest rolled up, fees, costs, everything owed under the loan agreement.
Then representations and warranties, reps and warrants.
Yes. These are statements of fact the pledger makes when signing. Crucial for IP. Things like, we legally own this IP. It's valid and in good standing. There are no other liens on it. Granting this pledge doesn't breach other contracts. If these are wrong, it can trigger enforcement.
And the ongoing promises, the covenants.
These are promises about how the pledger will behave regarding the IP while the pledge is active. They protect the collateral's value. Positive covenants are things the pledger must do. Maintain the IP registrations, pay fees, tell the lender about any infringement threats, take action to defend the IP. Negative covenants are things the pledger must not do without the lender's okay. These prevent actions that could weaken the collateral. Selling it, transferring it, granting exclusive licenses, non-exclusive might be okay under certain conditions, creating more security over it.
All designed to keep the IP safe and valuable for the lender. What actually allows the lender to step in? The enforcement event.
This is critical, and as we said, the collateral law allows huge flexibility here. It defines the triggers. Missing loan payments is standard, obviously, but it's often much broader. Breaching any reps or covenants, the pledger becoming insolvent, maybe even hitting certain negative business milestones related to the IP's value. That any event whatsoever, language gives lenders scope to define triggers covering various risks.
And the enforcement mechanics. How does the lender actually take action?
This clause spells out the process, leveraging those powerful out-of-court remedies from the collateral law. It confirms the lender's right to appropriate the IP, sell it privately, or appoint a receiver. A key negotiation point the source highlights is how the IP gets valued if the lender appropriates an independent expert. Internal assessment, quick quote, lenders want speed, borrowers want fairness.
Okay. Now, the really crucial part for convertible debt, the release of pledge termination. How does the security end?
This needs absolute precision. Under Luxembourg law, a pledge is an accessory right. It only exists because the main obligation, the debt, exists. Think of it like a shadow. If the object casting the shadow disappears too.
So when the convertible loan converts?
When the loan converts to equity, the debt is legally extinguished.
Yeah.
It's settled by issuing shares, not cash, that's gone. The inescapable legal result. The pledge, being accessory to that now gone debt, automatically becomes objectless. It is also extinguished. It simply cannot secure a non-existent debt.
Okay, legally it's gone, but practically?
Practically, this is vital. The source stresses that the pledge agreement and the loan agreement must have perfectly synced, ideally self-executing, release language. When valid conversion happens, the security must terminate cleanly in the paperwork and, crucially, be removed from public registries.
If not, that's the zombie pledge you mentioned.
Exactly. The risk is the pledge is legally dead, but its ghost remains on the public IP register, like the Patent Office or BOIP. This creates a major headache, a cloud on the company's IP title.
Which would scare off future investors or buyers.
Absolutely. They demand clean title to the core assets. Finding an old, undischarged pledge can stall or kill deals. The course points out that expert drafting to ensure automatic release on conversion is a hallmark of a well-run transaction, avoiding this nasty third-order risk.
Fascinating and a bit scary. Shows the detail needed. Okay, we've got the IP box, tax benefits, the collateral law security, the pledge mechanics. Let's put it all together. Convertible loans secured by IP pledges.
Yes, this is where the strategy really comes alive. It's the smooth integration. IP box efficiency making debt service cheaper, collateral law making the IP great security. Together, they enable this sophisticated financing tool.
Let's look at structuring the deal. Who, why, and when. Who are the usual parties?
Okay, the borrower. It's typically a Luxembourg entity, could be an alternative investment fund itself, maybe a RAIF, or Reserved Alternative Investment Fund, or an SCSP, that's a Société Uncommandite Spéciale, a special limited partnership. Very flexible partnership structure.
Or an SPV.
Or, quite often, yes, a dedicated SPV, a special purpose vehicle, set up just to hold the IP assets, often structured as a SOPARFI, a Société de Participation Financière, that's a standard, fully taxable Luxembourg holding company. This SPV might hold IP from several of the fund's portfolio companies.
And the lender, not your high street bank.
Generally not, no. The sources point to specialist lenders, firms that understand both venture debt and IP valuation and risk. Think venture debt funds, private credit specialists, institutional lenders focused on growth stage, tech, and life sciences.
Okay, and the why? What motivates each side?
For the fund or the company borrowing, the big driver is less dilutive capital. Compared to selling equity, debt preserves ownership for existing shareholders. It gives them cash to hit milestones, grow faster, maybe get a higher valuation next time they raise equity. And crucially, that low IP box tax rate, around 4.774%, makes servicing the interest payments super efficient, lower cash burn.
Less dilution, efficient servicing. And for the lender?
For them, it's a compelling risk-return blend. Downside is limited by that first-ranking security over the core IP, enforceable under the strong collateral law. Upside comes via the equity conversion right, or maybe warrants, letting them share in the company's growth if it succeeds. It's secure debt with an equity kicker.
Okay, and the when? When does this structure typically get used?
The source suggests it's often a capital bridge or growth financing tool used after a company has done its initial equity rounds, maybe Series A or B. It's for IP-rich companies needing funds to really scale up, expand markets, boost sales, fund the next phase of R&D to strengthen that core IP and build their competitive moat.
Right, leveraging existing IP for the next growth spurt without too much dilution. Let's look closer at the convertible loan itself, key terms.
Okay, it's a hybrid. Debt plus equity features. The interest rate is often a bit lower than plain non-convertible debt because the lender gets that equity upside potential as compensation. It can be fixed or floating, and very often includes peak payment-in-kind interest.
PI, meaning the interest isn't paid in cash.
Right, it gets added to the loan principal. Great for cash-hungry growth companies. The maturity is usually midterm, say 3 to 7 years. 5 years is pretty common according to the source.
And the conversion part?
Key terms here are the conversion price and premium. This is the preset share price for conversion. It's almost always set at a premium to the current share price when the loan is made. A higher premium makes it feel more like debt, often higher interest. Lower premium feels more like equity, often lower interest, more dilution. And finally, conversion triggers. How does conversion actually happen? Can be at the lender's option, they choose when or if to convert. Or it could be automatic, triggered by a specific event. Very commonly, that trigger is a qualified financing round, the company raising a significant new equity round.
Which brings us back to that critical legal point, extinction of the pledge upon conversion.
Exactly. This is where civil law principles really matter. Remember, the pledge is accessory to the debt. When the loan converts, the debt is extinguished, paid off with shares, the unavoidable legal consequence. The pledge, now lacking its underlying debt, also gets extinguished automatically. It has no legal basis anymore.
So the paperwork absolutely must reflect this.
Yes. The loan and pledge documents need clear, coordinated, ideally automatic release clauses. On conversion, the security must terminate cleanly, legally, and practically on the registries.
Avoiding the zombie pledge.
Avoiding the zombie pledge. The source really emphasizes that expert drafting here is crucial to prevent major headaches later on, especially during an exit or further funding round.
Okay, understood. So let's imagine the negotiation table. What are the typical sticking points between the borrower, pledger, and lender, pledge, when hammering out the IP pledge terms alongside the convertible loan?
Right, it's a balancing act. Lender security versus borrower flexibility. On the enforcement event, the borrower wants narrow triggers, maybe just serious payment defaults with time to fix things. Stability. The lender wants broad triggers using that any event whatsoever, flexibility covering covenant breaches, financial health dips, anything suggesting risk, early warning, maximum protection.
Makes sense. What about IP valuation if enforcement happens?
Borrower wants a fair, transparent process, ideally an independent expert valuation, so they get any surplus back if the IP is worth more than the debt. The lender wants speed and flexibility, maybe valuing it internally, getting a quick quote, the right to appropriate quickly without complex valuations.
And the covenants on managing the IP day to day.
Borrower wants flexibility to run the business, grant non-exclusive licenses, do R&D partnerships. Lender wants tight controls, strict rules to maintain registrations, pay fees, sue infringers, and definitely no selling, transferring, or adding more debt onto the IP without consent, preserving the collateral's pristine value.
How about the use of proceeds if the IP is sold or taken?
Borrower wants any money left over after the debt is paid, returned, ASAP, in cash. Lender wants to use the proceeds to cover all possible debts and costs, even potential future ones, and might want to hold any surplus until absolutely sure everything's settled.
And finally, that crucial release of pledge clause.
Borrower wants it automatic, immediate upon repayment or conversion, ensuring clean IP title for the future. Lender wants release only when every single cent of every possible obligation is fully, finally, irrevocably paid, no questions asked. Maximum certainty before letting go of the security.
That paints a clear picture of the negotiation dynamics. Definitely needs experienced advisors on both sides. Okay, let's shift to practical execution, costs, pricing, timeline.
Right, getting these deals done needs good planning and coordination. Costs fall into setup, maintenance, and the financing itself. Setup and maintenance costs. You've got corporate and notarial fees for setting up the Luxembourg borrower IP holding entity. The source mentions minimum share capital, 12,500 euros for an SARL, 30,000 euros for an SA.
SARL is a private limited company. SA is public limited.
Correct. Then, significant legal and advisory fees. This is for structuring, drafting, negotiating all the complex docs. Loan, pledge, intercreditors, corporate approvals, legal opinions confirming everything works, often the biggest upfront cost. And finally, IP registration and filing fees, the administrative costs to record the pledge at the IP registries like BOIP or the Patent Office to perfect it.
Okay. What about the financing costs, the venture debt pricing itself?
It reflects that debt plus equity kicker structure. Usually an upfront establishment or arrangement fee, maybe 1% to 3% of the loan amount, paid at closing. The interest rate varies, depends on risk, stage, IP quality. The source suggests maybe 15 to 20% per year for earlier stage deals, could be lower if the lender gets more equity upside, and often includes that cash-preserving PI feature.
And the equity upside piece, warrants.
Yes, the warrants or equity kicker. This is key. It's the right for the lender to buy shares later at a pre-agreed price. The amount, or warrant coverage, is typically linked to the loan size in place, maybe giving the lender rights to acquire equity worth 20 to 50% of the loan principal. This is a major part of their potential return and risk compensation.
Fees, interest, warrants. Got it. How long does a typical deal take? The indicative timeline.
Obviously varies, but the force suggests a disciplined process can take about 6 to 8 weeks from serious talks to money in the bank. It usually goes in phases. Phase 1, term sheet and due diligence, maybe 2 to 4 weeks. Negotiate the main commercial terms. At the same time, the lender digs deep. Standard business checks, but critically intense IP due diligence, verifying ownership, validity, registration, checking for any existing liens, really scrutinizing the collateral.
Okay, DD is key. Then
Phase 2, documentation. Another 2 to 3 weeks. Lawyers draft and negotiate all the detailed agreements, loan, pledge, intercreditors, board approvals, legal opinions, lots of paper. Phase 3, closing and perfection, maybe 1 week. Signed everything. Borrower provides final items like insurance proofs, legal opinions, conditions precedent. Lender wires the funds. And then, crucially, lawyers immediately file the pledge registrations with the IP offices to perfect the security against the world.
6 to 8 weeks seems pretty quick for something this complex.
It does. I think it shows how established the legal and financial plumbing is in Luxembourg for these kinds of deals. The collateral law processes are well-oiled.
Okay, we've covered the strategy, the pillars, the structure, the docs, the execution. Let's look ahead briefly and wrap up. The source mentions the upcoming regulatory landscape, things like AIFMD2 and DORA. How might they affect this?
Regulation always matters. AIFMD2, that's the Updated Alternative Investment Fund Managers Directive, is expected to bring more harmonized EU rules for funds that actually originate loans, like these venture debt funds. This should streamline things, potentially boosting Luxembourg further as a hub for private credit funds providing this kind of capital.
And DORA, Digital Operational Resilience Act.
DORA is more focused on tech and digital assets. It sets rules for managing ICT risk governance, reporting cyber incidents, managing risks from third-party tech providers. For funds or companies where the core IP collateral is software or digital data, DORA reinforces that the operational security and resilience of that digital asset isn't just good practice, it's becoming a regulatory requirement. It underpins the actual value and reliability of the digital collateral itself.
So resilience becomes part of the collateral quality.
In a way, yes. It adds another layer to consider, especially for tech-heavy deals.
Okay, let's bring it home. The source's conclusion stresses the importance of this convergence. What are the absolute key takeaways for listeners?
The main message, really emphasized by the source, is that this combination, the IP box tax regime, Article 50, TER LIR, and the Financial Collateral Law, Law of 5 August 2005, is an accident. It's deliberate Luxembourg strategy. It creates this sophisticated ecosystem for financing innovation, tax efficiency plus world-class legal certainty for security. So for you, the listener, if you're in this space, understanding the IP box nexus rules helps you maximize the tax value of IP. Knowing how to use the collateral law's safe harbor lets you turn that value into flexible, less dilutive funding via structures like these IP-backed convertible loans.
And for funds investing in innovation, mastering this is a core strategic advantage.
Absolutely. It's a tool to accelerate growth, protect equity, and ultimately drive better returns in very competitive tech and life science markets. It shows how specific legal and tax design can genuinely unlock value and fuel innovation.
It really does. And thinking about that 2024 defense of the collateral law's global reach.
Yeah, that sequence, the legislative clarification, the Supreme Court ruling, it wasn't just technical. It was a powerful statement about Luxembourg's commitment to maintaining that legal certainty for international finance.
Which leads to a final thought. What does this active, ongoing defense of legal certainty, especially around collateral for intangible assets like IP, mean for the future? As IP and data become even more central to global value, will other places try to copy this convergence? Or will Luxembourg's strong, established position give it a lasting edge in this specialized financing niche?
That's the question to ponder, isn't it? The need to finance innovation isn't going away. Jurisdictions that offer both smart tax incentives linked to real activity and rock-solid, globally trusted security laws for the assets driving that innovation, well, they're likely to do well. Luxembourg has certainly made its position very clear.
Something for everyone to think about as they consider investment strategies and where to structure deals. This has been incredibly insightful. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.